Okay, so now this is the last part of our chapter 5. So why we spend a lot of time for chapter 5? Because the chapter 5 is a very comprehensive chapters including many topics. So that's why we need to spend more time for this chapter to give you a detailed introduction for each different topics we have. So these chapters we need to devote more times than the other chapters, especially for some terminology you never seen before or some calculations involve many detailed steps. The last part of the chapter 5 we will study the forward market. It's including the forward rate quotations, long and short forward position, forward cross exchange rates, forward premium, and swap transactions. So what is a forward? Forward means something is not for now, but something will be, in the future. Something is forward looking. So on today's market, what dealers expecting the exchange rate should be in 1 month, 3 months, 6 months, 9 months, or 12 months later is called a forward rate. The forward market is involve agreements to buy and sell the foreign currency in the future times, but the price will be specified or agreed upon today, but the contract will be accessed in the future. So you can see here, right? The price is agreed on the spot times, but the contract will be delivered in the future times. And bank quotes is usually take 1 month, 3 months, and for every 3 months, you can see the frequency here. That's for the maturity for the forward contracts. And also have the longer term swaps will be available for quotations. And you can see that's the tables we capture from the large tables we have in the first class for this chapter. And we have the more quote available in that tables. You can go back to the first class of this chapter, right, to see a more comprehensive table involve more currencies. So these tables is between the British pound and US dollars. And the first one is direct quote, and these ones are indirect quote. And you can see here, this is a spot rate, spot. And these three are forward rate. Means maturity of the contract if you sign will be a month later, 3 months later, or 6 months later. So based on this quote, based on this number, what's the market participant expectation on this quote? You can see the number are what? Are increasing. For the same pound, the market participants expecting it will exchange for more dollars in the future. With the time matured, 1 month, 3 months, or 6 months later, the numbers goes up. A same pound get more dollars. So clearly, market participants they expecting the pound will be what? Will be more valuables. Or you can say worth more in dollar in what? In 6 months. And how can we solve the dollar-based holding period return? I mean, if you're holding the currency for a month, for example, based on the exchange rate over another currency. So what's your gain? What's your loss? You can see the calculation here. Suppose we're holding holding the pound, right? We try to buy a million pound, right? We try to buy a million pound and the spot rate and sell it in a forward contract. What's the spot rate? Spot rate is 1.4402. 6 months forward rate is 1.4416. 102. One's 1.4416. So based on this spot rate and forward rate, what's the gain? And you bought the currency with a spot rate and you sell it with a forward rate. That's this one. So the difference will be 1.4416 minus 1.4402 divided by what's the original cost to holding this 1 million pound. So that's 1.4402. And we have a million, so you can times a million if you want. Then this will be your what? It will be your percentage of holding period return for the 6 months what? For the 6 months forward contract. If you signed. But be careful. For a whole year, there are how many months? There are 12 months. That means 6 months. So after you solve the 6 months rate, this rate must times 2 to got what? To got our annualized holding period return. Be careful. Based on how many months for this contract. If you want to annualize, you should times by how many, maturities for a year. Then you can solve annualized rate. If we have the 3 months forward, then this will times 4. Next one. And we study in the first class of this chapter, when a dealer report a quote in the market, they need to save the time, and every market participants know the big figure. Big figure means the first 2 digits for the quote. So we only will pay attention is not to the not to the big figure. We don't bother to repeat something everyone know. We only will pay attention to the difference we have. So that's a small figure. That's a small fig. That's the last 2 digits of our quote. So for a month forward, you can say compare with the spot. What's the forward points? If you take the difference, will be what? Will be 1, and this will be what? Will be 42 minus 36 will be what? Will be 0.6. So our 1 month quote is 0.1-0.6. That's the difference in a small fig. And 3 months later, similar. We also take difference between the benchmark as a spot rate with a 3 months forward rate. So 48 minus 43. 48 minus 31. 48 minus 31 equal to 17. And 63 minus 36 equal to what? 27. So that's 3 months quote. Bid and ask. Right? Last quote is for the 6 months forward. So we use 88 minus 31 equal to 57, and 108 minus 36 equal to 72. So that's the 6 months bid and ask spread. Our benchmark is always the spot rate. Then we compare with our forward rate to see the difference on a small fig. Next one, the forward points. We need to restate the following quote. Use our forward points. Very similar to last one, right? Just use our forward rate minus the benchmark rate. The difference will be our quote in a small fig. So I don't repeat the same question again. You can try this one at home to solve the difference on a small fig as the quote. Next questions. The current spot exchange rate is $1.95 per pound. 3 months forward rate is 1.9 per pound. So based on your analysis, you are pretty confident the spot rate will be $1.92 per pound in 3 months. Assume you would like to buy or sell £1 million. So what action do you need to take to speculate the forward market? What's the expected dollar profit from this speculation? So speculate means what? Means you buy and sell in the short term to make a profit from the price difference. So if you believe exchange rate will be what? $1.92 per pound in 3 months, what you will do? You will buy something cheap and sell something higher in the future. So we will first bought our currency based on the contract we signed. We signed a 3 months forward contract, so we can purchase the pound by what? By $1.9 in 3 months later. Then we will directly sell it to the markets forward for $1.92. So this is the forward rate. This is the spot rate in what? In 3 months. So you can see the difference, right? So that's how you make profit. You sign a contract in advance, and based on the contract terms, right, you can get the pound to pay what? To pay $1.9 per pound. So you spend what? You spend $1.9 million to buy a million what? To buy a million pound. And you can directly sell this 1 million pound to the real market for what? For $1.92 million. So from your investment, the difference will be 0.02 million. That's your net profit from this speculation you have. So that's equal to the $20,000 you get. Okay, next one. What would be your speculative profit in dollar terms if the spot rate actually turned out to be what? 1.86 pound. Unluckily, right? You can say in the future, the pound is even what? Even less expensive because you signed a contract already. You don't have the option. You must to pay $1.9 per pound, but in the real market it's only what? Only $1.86 per pound. Right, so you lost what? You lost 4 cent. 4 cent. So you get what? You get $40,000 what? Loss. Right? This is a loss. You can buy something even cheaper from the market, but because you already signed a contract, you need to buy this one even more expensive than the market, so you take a what? Loss. I think this makes sense, right, based on your analysis. Okay, let's go to the next questions. The interest rate differentials are implied by the forward premium or discount. Premium is something what? Higher. Discount means something what? Cheaper. For example, suppose the euro is appreciating from the spot rate to the forward rate. So you can see this 6 months what? 6 months maturity forward contract, and the numbers goes up. So that means the euro is what? Is more valuable, so it's appreciating. And we try to solve the premium. Premium is a term. It's not for certain months. It's standardized for a whole year. But our contract is only for 6 months, so you must what? You must times 2 to get an annualized premium. That must be done because it is standardized for a premium or discount. Must always what? Annualized. So the first we solve the change, the percentage change. That's the forward price minus spot price over spot price, and this percentage change must times 2 to get an annualized premium. This formula you can memorize, but if you cannot memorize easily, just keep my word in your mind. It is always standardized for the annualized for the premium or discount. So the whole years will be 360 days. Divided by how many days for the contract, you will roll over the contract for the whole year based on its numbers. So that's the premium we solved. Let's apply these calculations, right? Apply this formula to some examples. So these tables give you a forward rate for yen between the dollars, and this one is in American terms, so it's a direct quote. So that means for a yen equal to how much dollar? This is indirect quote. So our premium compared with our spot rate is use the formula F minus S over S times 360 over how many days in a contract. For example, a month forward will be 30 days, 3 months will be 90 days, and 6 months will be 180 days. Depends on how long of the maturity of the forward contract. You will choose the number accordingly. So the first one will be the forward price minus spot price, difference over spot price, then times what? 360 over 30 days in a month. So that will be 12. So the percentage change times 12 will be annualized premium. For the 3 months and 6 months, similarly, right? Just choose the number accordingly, right? So the 3 months we use this one, 6 months we use this one. There's no big difference for calculations. The pattern of the premium is going up. Shows what? Shows the Japanese yen is trading with a premium against the US dollars because the number is going up. And it will become more expensive to buy a Japanese yen forward for US dollar in a future contract. And you can see there's another question very similar to what we just done. Right? Now it's turned to be the British pound. So this is the American term, this is the what? This is the European terms. Right? So this is the in dollar. And this is in what? This is in the British pound. So 1 pound equal to 1.4402 on the spot market, and 1 in the forward will be 1.4403. You can see for the same pound, it will get more dollar in the future. So let's solve what? Let's solve the premium or discount. So you can try this one at home. I will not give you the results directly, but if you want to do it, let me show you examples just for this one, please. So 1.4403, that's the forward rate, minus spot rate 1.4402, divided by spot rate 1.4402 times 360, that's the annual days, divided by how many days in this 1 month forward, 30 days. So this number times the 12 will be the premium. And you can see the numbers will be getting bigger and bigger. Means in the future, the pound will be more expensive. If you want to use the dollar to buy the pound, it will be more expensive. Okay, so the forward contract is very important. You can sign this contract to lock how much exchange rate you want to convert your currency in the future. There are also 2 actions you can get. For the forward position. One is a long position, one is a short position. Long means what? Long means you hold it, you buy it. Short means you sell it. You want to clear your position, you will do the short. Or you don't hold it, but you still take short, means you try to, do a speculation, right? You think the price will be getting down, so you will sell it from the borrowing from someone in the counterparty, and you will buy back in the future with a cheaper price, right? It's called a short. So I give you a simple picture to show what's the long, what's the short. For example, when you sign a contract, you only know the spot price and forward price on today's market. But in 3 months later, the price on the market is called a spot price, and times 3 will be not same as the forward price. It's very possible. If you hold a long forward, suppose the spot price on a times 3 is higher than the forward price, you are lucky. You can buy something with a cheaper price. It's already defined in the forward contract, so you have our profit. The higher of the spot price in the future will be more profit you will get, because you can buy something already determined in a predetermined, the forward contract. In a short position, it's opposite. because you sell it. You prefer the price to be as cheap as possible in the future. So if in the future the price is what? Is very low. So after you're selling this one, you need to buy back, right? You can get more profit if you can buy back this one with a cheaper price. So you can see that's the curve here comes from. So to do the calculations, not request for this part, but you don't need to know the details. Just have a basic understanding of these mechanisms, right? And also from this graph, you can tell a story. That's it. You don't need to go too very deep for this part. Let me show you a small calculations, right? Just get some intuitions. You don't need to do the calculations, right? It's not request. For example, and this is a forward contract, and I want to show the payoff of the profiles, right? Because payoff is different based on the future spot rate. So you sign a contract is a forward contract with 6 months maturity. And in this contract, you can purchase £10,000 with the price $1.4416 per pound. So that means you can pay $1.4416 to buy a pound in 6 months later based on its contract. But what exactly happened on the market can be different out of your expectation. For example, if the price on the market turned to be just equal to 1.4416 and there will be no gain, no loss, you just make break even, right? No gain, no loss. However, if the price are cheaper, but you already signed a contract, you need to buy this one what? More expensive. So you take a loss. The lower of the price in the future, you will take what? More loss. But on the contrary, if the price in the market are indeed higher than the contract price, then you are lucky because you can buy something cheaper with your contract and sell to the market with a higher price, so you make a profit. The higher of the price of this exchange rate in a 6 months later, you will get what? More profit. So that's the curve and number tells you about. Then I also want to show something for cross rates, because in the videos on our course website we have chapters do some examples for cross rates. Cross rates can be applied for the spot market, but can be also applied to the forward market. For example, you can say there are two forward contracts available for two different currency. One is the euro, one is what? One is the British pound. So for the 3 months forward between the pound and the euro, we can do our cross rate calculations, because in a table here, right, it is in the US dollars, so that means the dollar per euro equal to what? 3 months later, right? 3 months equal is here. It's 1.1353. And for the British pound is here. Means a pound equal to how much dollar? $1.4407. And your purpose is to solve the pound per euro. So we need to swap this one upside and down. So we need to take what? We need to take divisions, right? So we have the 1.1353 over what? 1.4407, and you got what? You got 0.7880 pound per what? Per euro. So you may wonder why it is a division. Why not a product? Because the dollar in both ratio are on the same side, is on the top. To cancel a dollar, you must take a division because they are on the same side. If they are on different side, then product will be cancelled out, is dollar. And which one should be the first? You can say the euro is already in a correct position, but this one's not, right? So this one should be the first, then divide by something you must to swap to the top, right? So it should be this one over this one. So we have the dollar over euro divided by the dollar over the pound. So as you know, for the inverse of the ratio, we just turn to be upside down. So we have the pound to the dollars, right? From the division to the products, you swap the position, and you can see dollar is cancelled out. So we have the pound to euro. That's what we want to solve. Last one is a swap. Swap is very important contract, and you can see that most of our foreign exchange trading is involved what? Swap transactions account for more than 56% in the interbank tradings, because there are too many settlement between two parties cross the boundary, right? Is involved what? The currency delivery. For example, if you have a trade with India and we use the Chinese yuan, renminbi, to pay what? To pay the India real. You must do what? Foreign exchange. But you're not sure India real will be more appreciable or less valuable in the future. So it's better to lock the rate to do some protections. So we can sign a swap contract. So in the future, when you need to deliver currency, you just need to swap, right? And you will automatically swap your own currency to the foreign currency. But swap is not our focus in these matters. It is covered fully in the chapter 14. If you have interest in this topic, you can go to the chapter 14 for more details. So why we ignore this chapter? Because in the financial major and also the other business majors, we have a special course called derivative, and this course is required for finance major and selected for the other majors. And in this course, the swap option and the future will have more details to give you, some instructions. So we don't go too detailed for this topic in this course. In a derivative, you can see more examples for that. So give you a summary, right, for this chapter 5. So the foreign exchange markets is our largest and most active financial markets on the world, compared with the other three, right? The other three involve stock market, bond market, and derivative market. Our foreign exchange market is the largest, and it's opening somewhere in the world 24 hours a day, because the time zone, right? When one market closes, the other markets will open. So it will last 24 hours for every second, every minute. 365 days a year. The foreign exchange market is divided into the two tails, right? The first tail is retail market, or you can say client market. The next tail is the wholesale or interbank market. And this is relatively small, and this one is in a large transaction units, right? 10 million is the base units. $10 million is the base units for interbank market. Foreign exchange markets participants including international banks, bank customers, non-bank foreign exchange dealers, FX brokers, and central banks. So you can say most banks are participants of the foreign exchange markets. In addition, the concept of a cross exchange rate was developed, and we studied the many calculations of the cross rate. And you should keep the rule right in your mind. It will help you to save the time to do calculations. Non-dollar currency transactions must satisfy the bid-ask spread determined from the cross rate formula, or a triangular arbitrage will be available for you to explore the profit. You can see the cross rate you solved from formula. If it is not same as the market rate, then it will be always a chance to explore arbitrage profit. That's all the topics in this chapter. So we have the very detailed lectures for these chapters. I have spent a lot of time to prepare the examples and show you the detail of the calculations. Please take notes for the calculations and be prepared to answer all the questions for this chapter.